Welcome to 3.4.1, the purpose of accounts for different stakeholders. So we're going to talk about final accounts here and how it's used by different stakeholders within the company. You have shareholders that are within the company, employees, and outside the company you have government and local community customers that would be interested. We'll go into who and why exactly in the next slides. So the final accounts firstly consists of two important sets of financial documents. Firstly, we have the balance sheet or we say the profit and loss account, and then we have a balance sheet. Profit and loss, just looking at the money coming in and out, simple, whereas balance sheets looking at the money that's coming in and out, and also uh, debts and money owed to the business, balancing everything that the business has in terms of the finance on a year-to-year basis. And the different stakeholders will have different uses for this information. So, as we mentioned before, who are internal stakeholders? Managers, employees, shareholders, simply put. And external stakeholders could be banks, suppliers, customers, and the government. The purpose of accounts for different stakeholders. So we've got this from the book, Table 16.2, Accounting Data and the Interests of Stakeholders. So the questions without the data: how much did we buy from our suppliers if you're not recording it? And have they been paid yet? Who's looking at that? Who's it affect? Managers and suppliers. How much profit did the business make last year? Who's interested in that? Managers, shareholders, and the tax authorities, because they don't tax you if you've made loss. Is the business able to repay a loan? Who's interested? Again, managers are interested in pretty much everything. Here, the banks. Can you pay it back? The banks get interested. If not, they might take legal action. Did we pay wages to workers last week? Who is interested in that? Workers. What is the value of fixed assets, and by how much did they lose value or depreciate? Lose value, depreciate last year. Who's interested? The managers and the shareholders. In a bit more detail, obviously you can take your time and pause if you would like, or you can just take some brief notes here on each one. Business managers, obviously, as you saw in the previous, they're interested in every part of the finances that are coming through, and they're ultimately going to be judged upon those key metrics of profit and efficiency. The workforce, the people who are working, employees, really mainly care about their salaries and their wages. If the business is doing better, maybe they can ask for pay rise if they're involved in it or if they feel it's doing good. And if it's not doing so well, it could affect them because their jobs may not be secure. So they might have to look elsewhere. If they see it's doing bad, they look to leave before being pushed out. Banks, we mentioned, if they've got loan agreements, creditors, people who are suppliers, they are looking at whether this company is doing well enough in order to pay back for stock or components that they're buying, and therefore maybe have a longer or shorter credit agreement. So you give them 30 days to pay back the debts or the credit, should we say, to pay back for anything that they're purchasing, or 60 days or 90 days, or you give them better discounts if they're better customers. We've mentioned customers here to assess whether the business is secure, to see, for example, if it's where they're buying electrical appliances, will they exist in a year's time? Will I be able to go there if I've got a problem? Government and tax authorities, obviously, to make sure that information is recorded and that they can tax accordingly. Investors and potential investors, obviously, they need to see the health of a business, that there are numbers, not just saying, oh, this is a great business, invest into it, but where is the documentation to prove that this business is doing well, or it can manage its debts well and at still at the same time be growing. And local community, it says see if businesses are profitable or likely to expand, which could help the local economy. If a local business is doing well, then it can help the local economy, people who are working in the economy, in those shops, and also providing an attraction to that location. The types of accounts, which we briefly mentioned, we're going to go into more detail with looking at an actual example of each. We have balance sheets, which is a statement of the financial position, an accounting statement that records the values of the business's assets, things that it owns, liabilities, people or organization, banks, which it owes, that needs to pay back, and shareholders' equity at one point in time. Normally, it's at the end of each year, but it could be a month. It could be a monthly, put as a group of months, with a yearly total, or it could be done as a year. Profit and loss account is just recording the money coming in and out. It doesn't include business assets. It doesn't include the shareholders' equity. It's much simpler. We'll go into that as well first. So again, just a summary in a different format. Its profit and loss account is called also an income statement, statement of profit or loss, or statement of comprehensive income. It just looks at the money coming in and out, like we said, and a balance sheet is also called statement of financial position. So for this purpose of not to get confused, we're going to use the terms profit and loss account and balance sheet. Okay, so now we're gonna take your time on this and follow it through. It is very, very logical. We'll go through it one by one. So let's take the pen. So sales revenue, money coming in, sales revenue. How well? Got rid of the let's get rid of that revenue part so you can see. So sales revenue is 700 million, 700 million in. Cost of sales, how much money, let's just say, did it cost to make that money? Like, for example, you've bought, let's say, X number of laptops. The cost of the laptop to you was 350 million, and you made another 350 million. So that was the cost of the sales, the cost of the product. And you obviously you bought it from China or wherever it is, and you made another 350 million. So once you take out your cost, what's left is called gross profit. Gross profit. My lines are a bit wonky today, so forget about that. Expenses are different things, like could be traveling, could be food, could be various things. Expenses need to also come out because they're immediate. So that's 200 millions come out. So as you can see, brackets means minus. Started off with money coming in, 350 out leaves you 350. So 350 minus 700, and here it got million. 350 minus another 200 for expenses, which are various costs, and leaves you with money for profit before tax and interest, which is 150 million. And then you have interest, 10 million. After the interest taken out, you have, so let's just follow it, 350 minus 200, 150. 150 minus 10, it's 140. 140 minus 25, which is tax from the government, 25% on this figure. or is, I don't know what, not 25%, sorry, but 25 million. It leaves you with 115 million. This is the profit. This is what you, this is actual profit. Yeah. All of this beforehand, you think, oh, 350 million, I've done so great. Not really. Or 700 million. You haven't made 700 million. It's not yours. It's not, there hasn't been, there's a lot of, uh, there's a lot of, you know, minuses that need to come. A lot of people need to take their money from it, including the banks for interest on debts that you owe, tax, and expenses as well. So look, you're left with from 700 million, 115. That's your actual profit. And how much of that can you touch? Depends on what agreement you have with your shareholders. Your shareholders may be taking 35 in this case, dividends. Divide. Remember this, I've taught this before to the other grades that have now graduated. To remember this, dividends is something that you pay to shareholders. Just remember, divide at the end. Divide, yeah. I see my straight line. Fantastic, because I'm drawing it with a mouse here. At the end. Divide at the end. Dividend. This money that you're going to give to the shareholders at the end of at the end of the year of the financial calendar. And then retained profit is money that stays within the business in the bank for whatever purpose it is. Here we've got 80. So this 115 is split into these two. Okay, so let's go on to this is a account profit and loss account for a for-profit organization. For profit, normal organizations that make profit, not a charity and not a social enterprise. So now let's look at a non-profit organization. Non-profit organization doesn't call it profit. Yeah, this is the main difference. We're looking at the same example of the money, but it says surplus instead of profit because they don't make profit. They don't take profit. They don't share profit. This is a big difference there. They do have expenses. You can see it's the same. They do have cost of sales, same. And they do have interest if they've borrowed money, of course. But there's no tax. No tax. No tax at all if they do not, if they are not a profit making organization, because it's a charity of some sort or social enterprise, which is comes under a non-profit organization. Some social enterprises come under profit organization as well. Depends on where they are in the spectrum. And here, instead of just being called profit, it's surplus. Yes, they did end up with more than they kept the tax money. So that's 125, so 115 against 140. But this is surplus. No one's taking this money on. It's because of the cause for which the business is running. Key terms, it will take time, and you probably have to read it again and again. In the beginning, obviously, when you're learning something new, it could take from, as I've studied, between four, let's see if we can draw four nicely, and 16 times. See if we can get a nice six here. Between 4 and 16 times to repeat something to get it in terms of, this is in language. Terminology, I don't know if there's been a study on it or if it's more or less, but let's just say you need to read more than once. And if you just read it once, it'll be in your short term memory. And if you're very lucky, you'll remember it the next day. It's not going to stay in there. And in business, we learn within context. So, cost of sales, which was written before, the direct costs for production, such as raw materials, component parts, direct labor. Maybe you need to even look at this slide, then go back to the previous slide. But okay, I can't show all of this within that slide. It's too much information. Dividends, like I said, payments divided at the end to shareholders. Expenses, examples of expenses are costs, indirect costs of production, such as rent, salaries, marketing, accountancy fees, bank interest charges, etc. Gross profit, which means the profit without taking, any of the costs out. Gross profit. The profit and loss account, also known as a statement or income statement, shows an organization's profit or loss after all costs have been subtracted from the organization's revenues each year. Profit before interest and tax means just that, because it has to come out. So, but it is noted at each stage: profit, gross profit, profit before interest and tax, profit before tax. But you can see that on the statement, the profit and loss statement. Profit period, normally it's a year. Sales revenue, money coming in. Retained profit, money that they've kept at the end of the year after they've given their shareholders their money that's been kept within the business. Take a breather if you're watching this all in one go, I'd say, because that's a lot of information.